Good evening. Welcome to another of our London South East Investor Evenings. Thank you all for coming. We've got a great lineup this evening. A little bit about us. I think a lot of you guys know us as a company, lse.co.uk, one of the largest UK private investor portals. We recently relaunched our website after 3 years of rebuilding it, and we've had about 1,500 people give us feedback on it, and some of it's been positive, so I appreciate that. It's been a labour of love for us, so bear with us on that one. Tonight we've got some great speakers: Graham Swindells, CEO of Cluff Natural Resources, Andrew Deenan, CFO of Coro Energy, Paul Haywood, CEO of Block Energy, I believe he's stuck in traffic, and Zac Phillips, who's an independent oil and gas consultant. Was that a fair description? Great stuff. Of those companies, Cluff Natural Resources has attracted 17,000 people to those pages on our website in the last month. Coro has had 12,000 people looking at the pages. I don't quite know what Block's been up to, but there's 127,000 people have been looking at their pages in the last month as well. That's about me. I'm going to hand over to Nigel, and do enjoy the evening.
Thank you very much indeed, Phil. Welcome to everybody. So oil and gas, always a very popular sector with our users at London South East, and of course the topic of much debate in the forums and the chat rooms. Clearly investors at this time want target companies with robust prospects. Clearly institutions we know are somewhat nervous of investing in fossil fuels, and listed companies will have the obligation on the LSE, London Stock Exchange, the other LSE, that smaller, less important one, forced from 2022 to disclose their risks from climate change. There are, of course, green energy targets to meet, and all these companies here clearly have been thinking about all these issues and want to put up a case for robust investment cases. So we're looking forward to hearing them. So let's get started with Graham Swindells, who's Chief of Cluff Natural Resources. His company has oil and gas assets. It's just announced a 15 million transformational fundraising. He himself joined the company in May 2013 as Chief Financial Officer, replacing Algie Clough as Chief Executive on the 1st of March last year. So will you welcome Graham Swindells?
Okay, so just a quick background to Cluff Natural Resources. We are an oil and gas investing company, primary focus on the UK North Sea, on exploration and appraisal, which is where we see the most amount of value being potentially created in the value curve. We have 7 licenses spread across the southern and central North Sea, both for oil and gas. This has been a relatively transformational year for the company. Earlier in the year, we farmed out 2 of our licenses to Shell. Previously, we were awarded an additional 6 licenses in the last year's licensing round. And as Nigel's just mentioned, we've recently completed a fairly substantial equity raise, which means that we are fully funded for our share of those 2 wells with Shell. So we're very excited about that, and we're fully funded for the foreseeable future. Total portfolio amounts to just over 2.4 TCF of gas. So in oil terms, that's the equivalent of about 400 million barrels of oil. And we're also looking to grow that portfolio in the next licensing round, which is due to open up literally within the next couple of weeks. Just in terms of board, Mark Lappin has recently joined our board as chairman. Mark's got a huge amount of experience in the oil and gas industry, most recently with Cordrilla and Centrica, but he's worked for a number of major oil and gas companies, including Phillips and Exxon, and brings a huge amount of experience to the board. The other key executive is Andrew Nunn, who's our Chief Operating Officer, geologist, and who leads our technical team, and he's responsible for identifying all of the overlooked and less well understood prospects, which we've successfully brought forward over the last few years. Just following on from our recent raise, we've really transformed our share register. previously it was almost entirely sort of retail. We brought in a number of key institutions as a result of that raise. Canaccord now being our largest shareholder, followed by IPGL, which is Michael Spencer's investment vehicle. That should actually be 16.8%, following his participation in the last fundraising. Lombard Odier with 8.1, Henderson 6.2, and after that Fisk and James Caird Asset Management, all of whom have supported us over a long period of time, and most recently in that raise. So very strongly backed now. So why focus on gas, and in particular the UK, which is our primary focus? Well, we believe that this is of strategic importance to the UK. It's a proven gas basin which extends from the northeast of England right through to the Dutch sector. The UK is facing a fairly major gas crisis, in our opinion. It was only a decade ago that we were entirely self-sufficient in gas. Now we are importing more than 50% of our gas, and by 2034 that's going to be 75% of our gas requirements are going to be imported, which creates a fairly major issue for the country as a whole, and something which we believe will need to be addressed. As far as the basin and the UK as a whole is concerned, the industry has restructured itself quite dramatically. We're now in an environment where, obviously, with higher and more stable commodity prices, coupled with a restructuring of the industry, with costs having come down quite dramatically, and a far more attractive regulatory and fiscal regime, mean that the North Sea is an extremely attractive place to be drilling now. And on that basis, we believe there's no better time to be drilling in the UK than now. So just a quick overview as to where we operate. Until recently, we were confined to what we call our core area of the southern North Sea, which is in the middle area there. Our licenses are in the blue. But as a result of the success that we achieved in last year's licensing round, we've expanded the portfolio to the south. We picked up a couple of additional licenses in the southern North Sea, but also to the north up into the central North Sea, where we picked up a couple of licenses. And what that's also done is added an element of oil prospectivity to our portfolio, which we'll come on to later. So southern North Sea, this is what we call our key and sort of core area, and this is where the majority of the prospectivity lies. Our licenses there again in the blue, but you can see all the red splodges on that are the existing discovered and producing gas fields. So you can see it's in a very much established play fairway. Say this is where the majority of our resource sits. So say the majority of that 2.4 TCF of gas, or equivalent of 400 million barrels of oil equivalent, are located. There's still a huge amount of prospectivity in this area, and we're focusing on sort of the relatively underexplored areas where we see significant upside. It's all relatively shallow water, so jack-up rig territory, which is much cheaper, and a significant amount of existing infrastructure in this area, which means that things can be brought online and commercialized relatively quickly and straightforwardly. So moving on to the first of the farm-outs and the first well that we anticipate drilling with Shell. You can see on this map where that star is. That is the Selene prospect, and you can see why this has been of particular interest to Shell. All those red squares are existing fields and infrastructure, which is operated by Shell as a joint venture with Exxon. And all of that feeds into the Bacton terminal, which you can see there in Norfolk. So, having kind of neglected this area of the North Sea through the downturn, Shell is very much focused on investing back into this infrastructure. They've invested heavily in Bacton and are now looking for additional fields to get further supply into that system, where it has significant capacity. We're particularly proud of this. This is the first farm out that Shell has done in the southern North Sea in the best part of about 10 years. And we don't necessarily anticipate them stopping here, but we're very, very excited and proud about that. In terms of the prospect itself, it's just under 300 BCF of gas associated with it. Terms of the farm out are such that Shell are taking a 50% stake in this license, and in return for that, they're paying us $600,000 of cash up front, and they're also going to be paying 75% of the costs of the first well, up to a total of $25 million. So a significant carry on that well, and we're fully funded for our share of the costs on that. But in effect, Shell are paying for half of our costs on that. We're currently working with Shell to get to that well investment decision, and if we can get that secured in the second half of this year, then we could be drilling that well in the second half of next year. So the second of the two farm outs with Shell is in relation to our license 2252, which includes the Pensacola prospect. This is a Zechstein Reef play, which is slightly different to the geology associated with the Selene prospect. In terms of size, it's not dissimilar, just over 300 BCF of gas. So on a net basis, just under 100 BCF to Cluff. The terms of this farm are such that Shell are going to pay 100% of the costs of a work program through to the earlier of the end of next year, or the point at which a well investment decision is made. And that work program is going to involve the shooting of new 3D seismic over that prospect. That's going to be new 3D, broadband 3D seismic, which has already been contracted. We know that seismic is going to be shot in the second half of August this year. This is a slightly shallower play. Well costs associated with this well are in the region of $13 to $18 million. So we will be retaining a 30% stake in that. And again, as a result of our recent raise, we're now fully funded for that, and fully anticipate that a well will be drilled on this license the year after next. This slide really just gives an indication of the level of interest and activity that's going on in our area. I don't propose to go into detail on this, but we've seen a number of major players investing heavily in this area in the last few years. In particular, Ineos, Spirit, and Neptune have all invested heavily at a corporate level. And the sort of light green boxes indicate a number of key wells that are going to be drilled in the course of this year in acreage which is adjacent to ours. Perhaps just to put things in perspective, there were only 8 exploration wells drilled in the whole of the UK side of the North Sea last year. So it's very encouraging to see at least 4 wells being drilled in our core area, and success in any one of these wells will be a very strong read across for our prospectivity. Already we've had, just in the last month, Rebold drilling their well at West Newton, which discovered gas. So already a very positive and strong read across for us on the basis it's a similar play. So this is the third of the prospects which we anticipate being drilled over the next couple of years. This is our license 2352, which includes the Dewar prospect, which you can see in orange in the middle of that map there. This was a license that was awarded to us just last year in the 30th licensing round. We hold it 100%, and we have done a significant amount of technical work on this license, which has significantly enhanced our understanding of the prospectivity, the volumes, and risking of this license. We hold it for a 4-year period, and what's of particular interest here is just in terms of offtake and potential farm outs is its very close proximity to BP's ETAP infrastructure, which is just immediately to the west. but also a number of other fields which are being developed. Culzean, which is being developed by Total, Merganser, which is Shell-operated infrastructure, and we've also got the Seagull field, which is currently being developed by Neptune. So a significant amount of work and activity in this area, which provides off-take opportunities for the company, and also natural farm-out partners. So we have just commenced a farm-out process on that license, and we're very excited about the prospects associated with that. Just a little bit further detail on the geology. It's 40 sandstone. It's a relatively straightforward play, unlike some of the more expensive HPHT type plays that we see in this area. In terms of the prospect size, we've got a P9 to P10 range of just over 10 to 80 million barrels, and a P50 recoverable of just under 40 million barrels. We've also just completed an economic study on this, which is demonstrating very favourable economics, with a post-tax NPV of £555 million. Chances of success are 41%, so relatively low risk for exploration, and that, coupled with the seismic data that we have full coverage over, means that we believe that this is very much drill ready, and we're very excited about the prospects for this and the farm out process that we're just commencing at the moment. And then I suppose the final two prospects which we have in our portfolio in the core area are the Cortez and Burbank prospects on license 2424 and Cupertino on 2428. We're currently undergoing a reprocessing exercise on each of those two licenses, and we anticipate commencing a farm out process on both of those licenses round about the turn of the year. Again, much of the drilling activity that we are seeing in the southern North Sea is in adjacent areas. Spirit and Juan Diaz are going to be drilling the Andromeda and Darrick and Aurora wells. And as I mentioned, if a successful outcome of any of those wells will be of very significant value to our company in terms of the read across. I guess finally, just whilst it's been a very productive and transformational year to date, we've achieved an awful lot. We believe there is significant activity and catalyst for the company, and the value, in particular, the value of the company going forward, both in terms of near term and long term. I guess in order of importance, we've got the Selene well, where we are currently working with Shell to get to a well investment decision, and if we can get that done by, or certainly in the second half of this year, that well could be drilled in the second half of next year. On Pensacola, the seismic is going to be acquired and shot over that prospect in the course of this summer. And following a period of processing and evaluation, we should be in a position to make that contingent well commitment firm in the course of next year, and a well to be drilled the following year. We just mentioned Dure. We've completed all the work in relation to that, and are now we'll now be running that farm out process over the second half of this year. And I say we're very excited about that. If we can get a successful outcome on that before the end of the year, again, a well could be drilled on that license as soon as the end of next year. And we've just mentioned Cupertino and Cortez, which will be the next two licenses off the block in terms of farm out process. And I guess in the background to all of that, we've got the 32nd licensing round, which is due to be opening up any time in the next couple of weeks. And we will certainly be looking to replicate the success that we had in the last licensing round, where we picked up 6 additional licenses in this licensing round as part of our plan to grow and diversify our portfolio and create multiple drilling opportunities going forward. So I guess just to sum up, the partnership with Shell has been really transformational for us and a major endorsement of the company and the technical team's ability to identify and work up less well understood or overlooked opportunities, and we've really been able to take advantage of the work that they have done as we've come out of the downturn. We've got these 2 farm outs with Shell, which gives a line of sight over the drilling of at least 2 wells, and as a result of our funding, we're fully funded for our share of the costs associated with those. We do still have the opportunity we've still got fairly significant equity stakes in those licenses, and the majority of our other licenses are held 100%, so we've got significant flexibility from which to farm down. And as I mentioned, we'll be looking to significantly expand and grow the portfolio and further de-risk the portfolio, creating the farm out and drilling opportunities of the future through the next licensing round. The company remains debt-free, relatively agile, low cost. We maintain very strict cost discipline, and we're operating in what we consider to be a very attractive regulatory and fiscal regime. So in summary, we believe this is a great time to be drilling in the North Sea. There's plenty of life left yet in the basin, and we're looking to continue to grow the company through partnership and ultimately through exploration success. Thank you.
So that's the first of our companies. A lot of detail there on the process and what's going on. Questions? Who wants to ask a question of Graham? There's one over here.
Thanks for the presentation. Very interesting. Your farm out with Shell and your relationship with them, they've got, I think, 70% of Selene, is that right?
They've got 70% of Pensacola, 50% of Selene.
Okay. And presumably at the moment you're talking with them, you're now funded for drilling, so you're probably having detailed discussions with them about the process?
Yes, certainly in relation to Selene. Obviously in Pensacola, we're committed to the acquisition of the new seismic, but certainly in relation to Selene, the primary focus is getting to that well investment decision so that we can start moving towards drilling.
And I mean, Shell's a huge company and you're a minnow. How do you make sure they follow through and drill? Because sometimes they get distracted and you might become a marginal interest to them. How do you make them follow through?
I mean, it's a very good question. I mean, clearly the respective difference in size is not lost on us. On the other hand, they behave very professionally and respectfully towards us. You wouldn't necessarily know or feel the kind of size difference when we have our discussions. In relation to the Selene well, we remain operator until such time as the well investment decision is made. So we are, to some extent, in the driving seat in terms of that process. Ultimately, can we make Shell and that organisation move any faster or slower than it would do otherwise? That is a very good question. But one thing we do know is that they are very much committed now to the basin, and particularly the southern North Sea, and in particular the Selene prospect, given its implications for the existing infrastructure that they have. The nearest field to them is the Bark field, which is coming off production quite rapidly. So they need to get more supply into that system and that infrastructure. And also, to some extent, it delays decommissioning liabilities for them. So there are very strong strategic, economic and commercial drivers for them to drill that well as soon as possible.
Okay, thank you.
More questions? One just here.
Thanks. Given Shell's interest in the southern North Sea and your technical expertise in finding exploration blocks in licensing rounds, can you see them working with you on future license round applications?
Yes, absolutely. And we're already talking to them about that prospect and that possibility. Shell, despite their size and might and also technical capability, have not invested heavily in exploration. You can even see that in their most recent results, where they point to reserves replacement as being a major area that they need to address. They've seen what our team is capable of in terms of, say, identifying and uncovering and progressing prospects which have previously been overlooked or less well understood. And I think they recognise that capability that we have. So to that end, we're already talking to them about the possibility of collaborating in the next licensing round. And at the same time, we're also, where we believe there's competitive advantage to do so, we are also talking to, and will also talk to other operators in the area. We have one of our licenses. We're partnered with Parkmead. Clearly, there are a number of other major players in the area, and where we believe there is a advantage to be gained from partnering rather than going 100% ourselves, then we will do.
Can you just say a little bit more about your style as a company and your own as chief? Because with all these projects, you're in the hands of geologists, all kinds of people saying this is going to be fantastic and this has been overlooked. I know you were in restructuring in the past. So how do you make it happen for shareholders? How do you sort of move out of something that isn't working and then capitalise with this low-cost way of working to actually deliver for investors?
Yeah. Well, I mean, there's a lot of trust involved. I've got complete faith in the technical team who have done a fantastic job. Yes, of course, we've had to be patient through the downturn, and there were times when you might have thought, well, is any of this necessarily going to come to fruition? But we've remained patient. We continue to invest carefully through the downturn. And I always believed that we would come good in the end, and we've seen that now. Naturally, exploration is one of the first things to go for major companies through the downturn, and for small companies like ourselves who have continued to invest through that downturn, we've now been able to put ourselves in a position where we're able to capitalise on the change in market conditions and the work that we've done over the last few years. Certainly, attracting the likes of Shell, a world-class partner, has been a key part of that. And again, we're looking to build on that. And the team as a whole, we've had to maintain very strict cost discipline as an exploration company through the downturn. But see, that's beginning to pay dividends now.
Okay, time for one more question, I think. Over there.
This is a quick question on the Pensacola one.
Yeah.
And in relation to your I think you're looking to do a tieback or access another pipeline to the T side.
Yes.
Gas processing. What's the timetable for that?
Well, I mean, the timetable will ultimately flow from the well investment decision. You're right. Certainly, this is an area where Shell doesn't have existing infrastructure, so we would be looking at either a tieback to the INEOS operated Brea infrastructure, or equally we could pipe it straight to the shore from that field. So we do have multiple options, and those will be addressed through that well planning phase, and at the point where a well has been drilled. But there are multiple options there, and we just need to work through what we believe will be the most commercially sensible route for us.
Okay, thank you very much, Graham.
Thank you.
Well, we move now to Coro Energy. This is a company that is big in Southeast Asia, focusing on upstream oil and Gas, a mid-tier exploration and production company. Andrew Deenan is the CFO, and he has many years' experience unlocking growth across AIM companies, both as a corporate financial and investment manager. So over to you, Andrew.
Good evening, everyone. As introduced, I'm Andrew Deenan, Chief Financial Officer of Coro Energy. First and foremost, I will draw your attention to the disclaimer. As the gents mentioned earlier, this will be available to you online, so take your time to read through that. First, I think it'd probably be useful to start with a short introduction to who Coro Energy are, how we came about, and what we're doing. Coro is a relatively new company on AIM. We admitted to trading in April of last year, raising £14 million of new equity in conjunction with the consolidation of two small Italian portfolios. The production portfolio of Saffron Energy, which has concessions in the Northern Territory of Italy, along with the Italian portfolio of Sound Energy. Combined, that gave us some scale in Italy, which is proving itself to be quite a difficult country to grow in terms of bureaucracy. However, actually, it's a very fantastic country to be in once you're in operations and you're actually producing. There's a good fiscal regime in place, there's easy to monetize your assets, and a very strong gas price there. What that platform, however, did for us was give us an operating platform with over 20 years of experience, operating onshore gas development, as well as having drilled high-pressure wells, which enabled us to go over and launch our growth strategy in Southeast Asia, credentialising ourselves with the host governments and being able to make the steps that we've made since April of last year. So we're focused on Southeast Asia, where we see a supply and demand imbalance, very strong local gas markets, even better than Italy, and also great opportunity for us to scale our business, find some scale, and we'll come on to how we've achieved that as well. So as I mentioned, in April of last year, we admitted to trading as Coro Energy. We raised £14 million, which was heavily supported by institution Lombard Odier and CIP Merchant Capital. We also have Conrad Energy, who are a 7% shareholder of ours, pursuant to the most recent transaction that we announced. And the balance of circa 50% is held with retail investors. So since we initiated our Southeast Asian growth strategy, we've done our maiden deal in Indonesia. We followed that up with an entry into Malaysia, and most recently, our second deal in Indonesia. We also had an opportunity of, So in terms of our board of directors, we're spearheaded by James Menzies, who's our Chief Executive Officer. James was the founder and CEO of a company called Salamander Energy, which was on the main list here in London, before it got taken over by Afear Energy for $850 million enterprise value transaction. James is a geologist by background. He spent the best part of the last 3 decades focused exclusively in Southeast Asia. So in terms of his opportunity, relationships, and ability to sniff a deal, he certainly is second to none. James Parsons is our non-executive chairman. He's the CEO of Sound Energy and non-executive chair of Echo Energy. We also have Fiona Macaulay on the board as a non-executive director, who's also the chair over at Independent Oil and Gas. And Marco Fumagalli, who represents the interests of CIP Merchant Capital, and he also sits on the board of CIP Merchant Capital's investment vehicle, which is the entity that holds the equity in Coro. Now, just to touch on James Menzies, as I mentioned, he was the founder of a company called Salamander, which got taken over by Afear Energy. It's not in this presentation, but if you look at our news feed, you will see that earlier this year we had an attempt to take over Afear Energy as well. This was quite a fortuitous opportunity. The company got bid for by a company called Medco on New Year's Eve, in an all-cash transaction of 55 pence per share. We were working with a tier 1 investment bank to bring about a counter bid, which would have been circa 40p in cash to those existing shareholders of Afear, and then a deferment and a roll-up into new equity in Coro. Unfortunately, we were the last horse in the race apart from Medco, and because we were using financing to do a leverage buyout, we would have to use a scheme of arrangement to make the acquisition successful, which would always require at least 75% of the votes to proceed. However, the night before we were about to announce our bid, we went to see the largest shareholder who I believe was an ARB fund who came in and only acquired his position post Medco's initial approach. However, he did own 22% of the company's shares. And in terms of our bid being part cash and part shares, I think, next phone call after our meeting was to Medco, and they increased their all cash bid to 57.5p per share, which at that point in time, he gave an irrevocable undertaking. So the likelihood of our ability to be able to transact and proceed, getting that 75% became very, exceptionally unlikely. So we had to buy out of the race there. But that just serves to give you a purpose of, as a small cap company, where we are today, some of the ambition that we've got moving forward, and in terms of that portfolio, certainly the magnitude of what we would have been able to achieve there. Now, coming back to Southeast Asia, which is our growth strategy, why are we there? Well, what we see is a supply shortfall. This is some data here that we've put together from data received from SKK Migas, the regulator over in Indonesia. And we can see that the existing supply is in decline. Future supply, which is existing discoveries which are coming on stream, has a nice bump there, and our assets are included in that bump. But there still remains a supply shortfall. So there's an upward pressure on gas prices here. And we already have a buoyant market with $5.5 to $8 per MMBTU in East Java, Indonesia. And over in Singapore, where one of our assets has access to that market, we see gas prices starting from $8 going up to $11 per MMBTU. This macro picture is verified by third parties. What you see on the right of that screen there is data produced by Woodmac, who are very respectable in the industry. And again, we see a supply-demand gap in the top chart there. So there is a requirement for new discoveries, a requirement for new gas to come online, and again, verification of the upward pressure on gas prices. And here we see, just below that, the second chart down, where Woodmac believes that shortfall is going to be made up from. And if we have a look at what that circled area represents, we see new gas discoveries and uncontracted pipeline. So that's the area where we see an opportunity for Coro to play a role. Uncontracted pipeline would be discovered resources that are yet to be commercialised, and obviously new discoveries, we all know about exploration. So we see an opportunity set here for a small cap E&P company to come in and play a very proficient role set against the macro picture that requires people like us to be coming in. Our strategy is what we term a hub strategy. So we're not big E exploration here, we're small E at best. Our preference is to get an asset where there's an existing discovery. Fallow discoveries, there's many that we can talk about, and I'll come on to that on my next slide. But in buying fallow discovery or an existing discovery, you have a safety net there. There is an asset or a resource that we have a strong belief that we can commercialise. So we have a forward trajectory in any event. But often or not, what you find is that the smaller the fallow discoveries are often very much larger than what people initially think. And James at Salamander has proven this many times before. In fact, James Menzies did a deal with James Parsons 7 or 8 years ago to buy sound energy out of an asset in Indonesia where Salamander were operator. In doing so, they thought at that time it was about 250 BCF discovery. With small E exploration, it turned out to be 800 BCF, and that's still chugging away and was one of the main backbone assets of what was formerly Ophir and now is Medco. So we're looking for existing discoveries where we've got a resource in the ground that we have a strong belief we can commercialise, where we can see opportunity sets to do small E exploration, drill the next bump along, not taking frontier risk, but if those types of opportunities come in, they're massively value accretive because you can tie that back to your existing infrastructure and then pick up the surrounding acre around that. And what we find in doing that is we get an enhanced technical insight because we're working the same geology, the same rocks, operational flexibility in terms of how you monetize the assets, in terms of how you make those discoveries, and the financial synergies that come with being able to tie back to infrastructure or other equipment. So from our perspective, we're looking to build a portfolio of 4 to 5 of these hubs. And in doing so, what we will then have is a portfolio, hopefully of a large operated equity participation, but of assets at different parts of the maturity curve. So we'll have we aspire to have some production, which throws free cash flows off. We use those free cash flows then to explore, develop, the less mature elements of the portfolio, and then we've got an engine that we can continue to grow, self-sustain itself until you get towards a level of 20,000 barrels of oil production a day, and then you're a real target for a major or an existing large company to take you out. So that's the journey that we're following. In terms of fellow discoveries, these have been a great source of value for independents in the region. This slide here, we're showing you when discoveries were made versus when they were commercialized. And what you can see here is that the entity or the company that makes the discoveries, often or not, it was very rarely the entity that actually commercializes the resource. In fact, in some instances, they can stay there for 30 years without being touched. So there is a great opportunity for us to pick up existing resource that's in the ground, that we have a strong belief we can commercialize, but also not taking the frontier at big E exploration risk. Now, our first transaction was in East Java, Indonesia. We picked up a 42.5% interest in the Bulu PSC, which contains the Lengo gas field, which has been independently certified to have 359 BCF of 2C recoverable. From our perspective, that's brilliant because it's a very simple operation to bring that into production. Four wells tied back to an unmanned offshore platform, 60-kilometre pipeline back on shore. There is 12% CO2 in this gas, so it will have to be a thick steel carbon-lined pipe. But there's a very buoyant gas market there in East Java, petrochemicals, power gen, fertiliser. So we have 6 MOUs signed with potential gas buyers, which we hope to convert into a gas sales agreement later in this year. The asset itself lights up on seismic, as you can see, so it's very well defined. We've had 2 wells drilled here, which have both been cored and flow tested at 13 million scuffs a day and 21 million scuffs a day. So we know it's a commercial flower. And we acquired this resource for 10 cents per MMBTU, paying the vendors $8 million in cash and up to $4 million in shares. We have development costs of circa 80 cents to $1 per MMBTU, and then we'll have operating costs of circa $1.10 per MMBTU, and that's set against the backdrop of a gas market which, as we spoke of earlier, is $5.50 to $8 per MMBTU. So there's a lot of margin there for us in terms of developing this and commercialising this resource. This one itself doesn't have a great deal of prospectivity on the upside, so we're looking at opportunities around the acreage around here that can dovetail in. There's quite a few that meet our criteria and synergies, but as we spoke of, very simple development, 4 wells tied back to an unmanned platform with gas piped onshore. We have an approved plan of development in place with the Indonesian government. The gas sales agreement is the next milestone that you should hope to see us sign, and then we can move towards FID and hopefully bring this asset into production for 2021, maybe slipping to early 2022. The third transaction that we've announced, and I'll come back to the second shortly, is another asset in Indonesia. We acquired a 15% interest in the Duyung PSC, which contains the Mako gas field. Now, this is in the West Natuna, which is actually the asset lies adjacent to the West Natuna transportation system, which is the large pipeline infrastructure that runs through Indonesia and passes actually by Singapore, which is where we have heads of agreement signed with the gas buyer. The Singapore market is probably the best market in Southeast Asia to be selling your gas to. They import all of their energy. So we see gas prices there, as we spoke of earlier, $8 to $11 per MMBTU. Again, what we have here is another asset which lights up on seismic, and that's due to the fact that it's only 400 metres below the mud line. So it's very shallow gas here. We also have 4 penetrations through the gas field, so we do know there's gas there. The Mako South well was cored and tested at 10.8 million scuffs a day. So again, we know that we can flow commercial gas here. And these shallow fields aren't new to the industry. We're not reinventing the wheel. They are out in the Netherlands. They've been operating for 20 years now. So it is a relatively vanilla operation, quite similar to the Bulu PSC. Here we've acquired our 15% interest for a total consideration of approximately $15 million. That is paid as $2.95 million in cash to the vendors, plus $1.85 million of Coro shares valued at 2.35p, which are locked up until we have the results of the upcoming drill program. We're then also paying $10.5 million into the program to fund the upcoming drill program. So our money is going into the ground here, not going into anyone's pocket so they can go and spend it elsewhere. Only 2.9 has to go there. 10.5 of it goes back into the ground here, which is much preferred as to how we would like to transact with vendors. We have a biogenic gas accumulation here. And in fact, back in the 90s, our CEO was responsible or on the drill team for the Chakalang well, which is this well here, targeting deeper horizons. They actually knew that this gas field was here, but they actually viewed it as a hazard back then because of the shallow nature of it and the technology at the time, and were concerned about a potential blowout. Having drilled this though last year with the Mako 1 well, we now know that that's not the case. So here we have 276 BCF of 2C resource, independently certified by Gaffney Klein. And this, in end of Q3, beginning of Q4, we'll be drilling here. We're drilling 2 wells. One will appraise the southern end of the field where you can see there's no penetration, so drilling down here. And the other well is up north, which will be Tambak. Now, Tambak, so both of these drills will appraise our existing gas discovery. But in the north, we'll be deepening the well to test a 250 BCF mid-case prospect. Now, as I said, here we had Mr. Menzies back in the 90s drilled Chakalang, which is this well here. You can see if we look at the structure map here, you've got a high here, a high here, and a high here. This one and this one have both been drilled and they were both dry. Now you might say, why then are you drilling here? And the reason why we're drilling here is because the current operator did something smart. They took the amplitude extraction and laid it over the structure map. And what you can see is in this perforated line here, the amplitude lights up. And that's telling you something. There's something going on in this middle bump here that wasn't going on in either of the other two. So we have a quite high, in the context of exploration, chance of success here, estimated to be at 45%. And if this came in with a BCF range, mid-case of 250 BCF, we have the opportunity of potentially doubling the existing resource. Now, the incremental cost of testing that is an extra 2 days drilled for us appraising the main field anyway. So that's the type of exploration that we like. Lower risk, safety net is we're appraising our field in any event, so we're going to get the right data that we want in pursuing that. But if it comes in, the incremental cost of that additional 2 days to double the size of the resource would change how we market the gas and how we develop the field. So we'll be drilling that this year. This transaction we funded with the issue of a €22.5 million Euro bond. That Euro bond, half of it was subscribed for and underwritten by Lombard Odier. CIP Merchant Capital also participated in that. They think they subscribed for €4 million, and we brought in new institutions as well who took up the balance. So we're fully funded to complete this transaction, which has gone through, complete our drilling commitments for this year and through to next financial year and beyond. In December last year, we announced our initial entry into Malaysia with a joint study with Petronas on Block 2A, which is offshore Sarawak. That Sarawak's been in the news recently. There was a 2.5 TCF discovery, actually just southwest of where our block is. And also the Bintulu LNG plant lies here offshore here. And that's the second largest LNG plant in the world. And again, that's been in the news or in the industry press regards facing potential shortfall. So the macro picture here looks very good as well. This, however, is off strategy for us. This is big E offshore exploration, which isn't what we primarily want to be focusing our attention and resource on. However, we have been knocking on Petronas' door. We see Malaysia as the great opportunity and fairway for Coro to really propel itself. There's 174 fields there which are vacant and not allocated. There are very little independent E&Ps there. There's very few at all. And that's a result of the high standards and the high barriers to entry to get into Malaysia. And that's important as I go back full cycle to Italy and the credentials that that gives us in terms of 20 years track record, having drilled high pressure wells and having developed gas fields. So expect to see us do more in Malaysia. There is a discovered resource bidding round coming up later in this year. James Menzies apologises he can't be here tonight, which he had intended to be, but his trip to Asia has been extended. We met with Petronas last week as well. So Malaysia is very much a key focus for us. Despite the high barriers to entry, we think there's a real good opportunity set for a small cap player coming in. So just go back to our portfolio here. So in the last 18 months, we've done 3 transactions. We've taken our initial Italian platform, which had 30 BCF of 2C reserve and resource. Our Bulu transaction saw a 500% increase in that to 184 BCF, or approximately 32 million barrels of oil equivalent. And post the Duyung acquisition, we now have approximately 40 million barrels of oil equivalent reserve and resource. And we've also added some prospective resource with the 2 prospects that we have there. In terms of news flow, the Duyung PSC, we are drilling end of Q3, beginning of Q4 with 2 back-to-back wells. They'll be approximately 30 to 35 days each. In the Bulu PSC in Indonesia, East Java, we would hope to achieve a gas sales agreement by the end of this year, and then we can move to project final investment decision and begin the development of that field as well. In Malaysia, we're completing our joint study with Petronas on Block 2A. We've seen some exceptionally interesting data there, despite it being non-core or off strategy. There is some very exciting stuff there. So expect to see us mature that joint study into a PSC, and off the back of that then we can be a lot more vocal about the data sets that we've seen there, the information that we have, and the opportunity that we'll be playing for. And then additionally, Malaysian business development is continually ongoing, as well as in Indonesia, but Malaysia is where I'd hope to see us do more business sooner rather than later. And that's a key message for us. We are very much a business development unit at the moment. There is a great opportunity in Southeast Asia at the moment. There's rotation of majors out, which creates opportunity for small and mid-cap independents to replenish their exit. But that window is closing, and we've seen a lot of transactions going on. I think Medco and the AFIA serves as one illustration. You've had a PTT taking big positions in Malaysia, OMV coming in with the change in guard in government there as well. So that window is closing. It's for us to get after it and complete transactions, but we're very cognizant of selective order and making the right decision. So yeah, I think in summary, we're a tenacious team that have raised money from institutions. We're fully funded for all of our operations for the next 12 months and beyond. And we are heavily involved in BD, so expect to see more from us soon.
Okay, so questions for Andrew? Quite a lot of ground covered there. One at the front here, Donald.
Thank you very much. With respect to Indonesia, I noticed they were offshore developments. Have you looked at onshore developments as well?
Yeah, we've looked at a couple of onshore opportunities, production and development stage. Onshore can be difficult, principally because you're hacking your way through jungle, mountain terrain. That takes time, adds costs. Mr. Menzies would profess to that, having developed Kalimantan, which was the asset he bought James Parsons out of. There were time delays operating onshore just because of the sheer nature of the geography that they had to, the terrain that they had to work through. Offshore has environmental issues, which are obviously naturally in place there, but it's pretty simple stuff. As long as you can get those approvals and the environmental ticked off, there's less operational challenges and issues for us, or in our opinion, to be able to have a seamless operation.
The biggest handicap or challenge for overseas companies in Indonesia is the regulatory authority. So what are you doing that's special?
So in terms of the regime over there and the regulation over there, that's going through change at the moment. So we're seeing a switch from the traditional cost recovery production sharing contract to the gross split contract. In terms of economics, we're actually seeing an improvement in NPVs despite maybe a slightly increased time to recover your initial capital. In Indonesia, though, you need to be careful who your partners are. That's where you need to tread very carefully. There's a lot of fallow discoveries and existing production that are owned by indigenous Indonesian companies, and often or not you see that they've done nothing through the 5-year term of their initial contract, and then there's a mad scramble before it sort of gets taken away from them for them not completing their commitments. There's been resource nationalisation as well, more in the mining space than the oil and gas space. Indonesia, let's not forget, we're the pioneer of the production sharing contract. That was the first country to bring the PSC out. So oil and gas industry is very much the backbone of Indonesia. They understand E&P, their investors don't. Their investors like service companies, but they don't take the E&P risk. But in terms of operating there, we've got a CEO who's been in the region for 30 years, who's grown a business. We have special advisor to the board, former director of the board is Ilham Habibi, who was the son of President Habibi, who helped take the country through technology revolution. So he helped steer us or guide us in terms of any issues that we want to verify or double check in terms of who we're partnering with or how we're navigating forward.
Thank you for that question. Anybody else? Well, just probably time to take one more from the floor, but while we're thinking about that, can I just ask you, obviously at the moment, the investment environment for oil and gas is more difficult. The institutions are concerned about sort of future targets, legislation, about renewables. How comfortable are you with the environment? You'll be able to raise the sums that you need, and being on AIM for that matter?
Well, our assets are all gas assets. So we see gas as the transition fuel to a bridge between oil and renewables. There's a huge upwards pressure on gas prices there because of the supply imbalance. So we don't see gas being replaced imminently. Certainly our projects will play a part in helping recouple that demand-supply imbalance. But yeah, we're cognizant of it as the whole industry is at large. But yeah, gas is our focus, and we think that's the halfway house.
Okay, well, you've stunned the audience into silence with all the detail you brought us. So thank you very much indeed to Andrew Deenan, and thanks for standing in for your chief. So let us move on to Paul Haywood. He's talking now about a very different part of the world, that is Georgia. It's another AIM-listed company. He's got a wealth of corporate and operational experience, including 6 years, I'm told, in the Middle East, building early stage and growth projects and senior management roles with UK and Australian public companies, all in the natural resources sector. So let's hear from Paul and see about Block Energy.
Thank you. Thank you for the introduction, Nigel, and thank you for your time, ladies and gentlemen. So Block Energy is, of course, an AIM-listed company. We listed on AIM back in June 2018, having raised £5 million to execute what we believe to be a somewhat low-cost, low-risk work programme. We've just come to the back end of that work programme, having drilled a hugely successful well in our West Rustavi permit, which I'll go into a little bit more detail as we move through the slides. I've kept the slides as light as possible in the text. I'll be hanging around after the presentation for a conversation if anybody wants more detail. And of course, we've left the more detailed presentations at reception if you guys are looking for more detail. So as touched on earlier, we've got an oil and gas portfolio located in Georgia. We've just proven productivity of our flagship West Rustavi permit through an exceptional test of a horizontal well that we recently drilled, which was performed in well 16 AZ. The economics associated with the production sharing contracts in the industry are second to none. I've spent a hell of a lot of time working throughout the region, and the fiscal terms associated with the PSCs in Georgia are some of the best I've come across, and I'll go into a little bit more detail as we move through the presentation. Fantastic netbacks. Currently we sell our crude at 65 at Brent minus a small discount. Gas sells anywhere between $7 to $8 an MCF in country, and is in high demand given pretty much 100% of supply is presently sourced from Azerbaijan. Company's current focus, consequent to a recent £12 million fundraise that was executed last month, is to continue doing more of the same. Re-entries of existing discoveries, drilling more horizontal sidetracks for our existing wells, and significantly ramping up production. The team is somewhat self-explanatory. I must say the core team actually sits in Georgia. We operate our 3 fields, and we've got a team of circa 65 people out there, which is a mixture of skilled local workforce and expats that work amongst the Georgians that we source from both Canada and the UK. I myself, I've been working in Georgia since 2010. I've been involved in multiple acquisitions. I've been through the acquisition, development and sale of multiple assets in country, so I guess my specialty is somewhat the above surface environment. Philip Dimmock is our chairman. Phil spent a lion's share of his career with BP. Other roles include Ranger CNR, where he was also VP of operations at Vanco. Myself and Phil crossed paths in Georgia actually back in 2011. He was looking to engage with a local private company at the time, and consequent to our engagement, he ended up becoming a technical director of a company that I worked with previously in a previous life. So myself and Phil worked together for a couple of years, and Phil was then invited to join the Block Energy creation, which occurred back in 2017. Roger McMeehan is our technical director. Myself and Roger crossed paths again whilst in Georgia. Roger was operating a neighbouring field and is somewhat of a kind of re-entry completion specialist, and that's what he prides himself on. And given the work programme at hand and Block's focus going forward, I thought Roger would be fantastic to lead a company from a technical sense, and given the most recent success, I think he's proved us right in that sense. Niles Tomlinson is the company's executive director. He's an energy and mining analyst that's been with the company since inception. And Chris Brown joined us as an NED early part of last year, actually, and spent lion's share of his career with Shell. Just a brief summary on Georgia. So, of course, we're located just south of Russia, north of Turkey, and we've got Azerbaijan off to the east. A few points of note. You've got one of the world's largest pipelines that transports around 1 million barrels of crude a day through Georgia, through the corridor of the area of interest, actually, which I'll go into on the following slide. That's majority owned by BP and is operated by BP, who have been in country since 1998. You've also got the Southern Caucasus pipeline that transports Shah Deniz gas from offshore Azerbaijan through the country and down into Turkey, again, majority owned by BP and operated by BP. The area of interest that you can see highlighted in yellow is pretty much where all of Georgia's oil has been produced to date, actually. Over a couple of 100 million barrels have been produced from that area, and that's pretty much where our focus to date has stayed. The country is split somewhat in 2 halves. You've got the Rioni Basin that runs off to the west, and then you've got the Coro Basin that runs down to the east, off into Azerbaijan, and as mentioned earlier, that's been one of the most productive areas to date. This is an interesting slide, as it gives a nice visual on kind of where the productive areas in Georgia have been to date. And so we've got 100% working interest in Norio, and apologies for the cameraman here if I'm moving away from making things difficult for you. 100% working interest here in Norio, and we've got a 90% working interest in Sats-Kanesi. They're both shallow oil plays that are produced primarily from the Myakop in the shallower zones, so anywhere between, we're producing oil up in Norio at depths in and around 1,000 metres, there or thereabouts. Those of you that have been following the company, we've pretty much kicked off with a work programme in Norio and Sats-Kanesi, which was a re-entry programme and just basically re-entering historical wells. And then moving down into the more prolific areas, and we see this to be somewhat the fairway in Georgia, actually, of the Middle Eocene, which has been to date the most productive horizons. These highlighted green areas are the larger fields that have been established in country. This area here is a Samgori field. Peak production back in the late 70s, late 70s, was about 70,000 barrels of oil a day. Cumulative production from this area alone is around 210 million barrels, all from these zones here. So the upper, middle and lower Eocene. There's been some successful gas tests actually in the upper Cretaceous, but I'll get into that in a bit more detail as we move through. So we're 100% here, 90% here, and the operator. We've recently moved to 71.5% in West Vestavia. This is where we've just drilled our most successful well. And we're in the process of exercising our option to move to 100%, which I expect to happen somewhat imminently. Often we get asked the question, what's it like to operate in Georgia? There's been some problems in the past. What's it like getting stuff done? I think this is probably one of my favourite slides actually, in that it clearly demonstrates that both above surface and subsurface environment is an area that we can handle in block energy. As you can see, since IPO, we've acquired an interest in West Vestavia, so we've done some commercial transactions. We've mobilised drilling equipment and crew. We signed an offtake gas agreement with a local purchaser. We've got busy with our Norio work programme, which occurred in and around the end of September, beginning of October. We increased oil production in Norio and Satskanesi, albeit the market didn't pay too much attention there, as you can see. We went from 10 barrels up to around 60, which gets that field break even and kicks off a bit of free cash for the company. And then we moved into our sidetrack programme in West Vestavia. And needless to say, that's where we got the most excitement and most recognition from the market. Forecasted rates at West Vestavia were around 325 barrels. 325 barrels was our IP, and obviously the tests come in at over 1,100 barrels a day. We've pretty much doubled the country's production overnight, which was so we're seen as a bit of a poster boy for Georgia at the moment. We've got lots of support from the government, and they're making lots of introductions to current asset owners and third parties showing interest in the country, somewhat consequent to our success in West Vestavia, I believe. These numbers here are a little bit, they're not as up to date as we'd like them to be. We performed a CPR as part of the IPO process in 2017. And these are the numbers that were derived from our positions in Norio, Satskanesi and our minor position in West Vestavia, albeit the PSC had not been issued in West Vestavia at the time in which the CPR had been prepared. So we were going off of somewhat legacy data, and we definitely didn't have a successful well in 16AZ under our belt. So going forward, part of the forward plan, outside the obvious, and that's drill more wells, the plan is to redo our CPR, and we'd expect quite a significant upgrade to come consequent to that work programme. We've got many different mantras internally at Block, but one of my favourites is, our focus is on converting contingent resources into reserves. We are taking no exploration risk. We're going back into proven discoveries, and we're simply deploying Western technology that's being used in the Western world for the past 30, 35 years into proven plays. So we're not doing anything fancy. So a little bit more detail on the licence areas, which won't take too long. So zooming in West Vestavia and kind of touching on the immediate programme in which we're fully funded to execute, consequent to a £12 million raise. 16AZ is where we've obviously just re-entered. We drilled down to 2,100 metres, and then we drilled a horizontal section in that well of up to around 550 odd metres. Plan going forward is we're going to move over to well 38, which will be spudding this summer. I don't know if those of you that do follow the company will see that we've recently upgraded our storage facility, so we've now can store up to 90,000 barrels worth of oil as storage. And we've also recently just secured a 12-month rig contract with one of our largest supporters in country. So we'll be spudding well 38. Again, nothing fancy in 38. We're going back into a proven discovery. We're drilling down to around 2,200 metres. Then we're going to drill an up to 700 metre horizontal sidetrack in an attempt to increase our P50, P90 resource and reserve boundaries, basically. Post 38, which we think will take us anywhere up to circa 60 days, there or thereabouts. We'll then move the rig and the crew straight across to well number 30. 30 is slightly different in the sense that 30 is well number 30 historically discovered some gas. So we're going to go down into the lower Eocene. I should also mention that these two plays that I've just mentioned here are all Middle Eocene plays. Well number 30, we're going to go slightly deeper. We're going to retest a legacy gas discovery, which we think will help us convert what is a pretty significant resource number, which I'll touch on in the next slide. And then we're going to come back up in that wellbore and we're going to drill out into the Middle Eocene, and then we're going to bring it online as an oil product producer. So we'd expect to have these two wells done by the end of this year, and we'd expect production to be up to around 2,500, 3,000 barrels a day, there or thereabouts. In parallel to all the drilling activity, we've got a 3D seismic program planned, which we hope to have acquired by the end of this year, and then that will basically to support the company strategy on its new well development program, which on a P50 basis is circa 15 new wells throughout West Vestavia, which, just to put things into context, is about 38 square kilometres. So here's a, let's go back one, there we go. It's just a simple cartoon on just exactly what we did with well 16AZ. It's a fractured reservoir play. We've got the Middle Eocene for us is around 250 odd metres. Well 16AZ was previously drilled down to a depth of around 3,200 metres and produced for some time. We basically suspended, we plugged off the deeper zones, and as you can see here, we kicked out at 1,925 odd metres, landed down at a depth of around 2,100 metres, and then we drilled our horizontal section. As touched on earlier, the kind of, I'm going to say secondary play, but the headline play for us is proving up the gas resources. We've got a contingent gas resource that's been attributed to West Vestavia of 608 BCF, which, given current local gas prices and now assumed final development costs, gives the company access to some significant upside, which is why the focus going forward is on proving up this gas. As you can see, these red dots here basically highlight the gas discoveries that have been had around us. This blue block beside us is currently owned by Schlumberger, who are 100% and they're the operator, and they've just finished drilling their first gas well. And as mentioned earlier, we're going to be going back into well number 30 and retesting a gas discovery that initially flowed at 1 million cubic feet a day. Now, the difference that we'll be making with that particular re-entry is that we'll be drilling up to 700 metre horizontal sidetrack, and we'd expect to increase initial production rates significantly. Just up into Norio and Satskanesi, given the success that we've had in West Vestavia, focus going forward is primarily kind of sticking with West Vestavia actually. We've got some recompletions planned and a possible sidetrack plan for Norio. We have got a contingent resource base of around 37 million barrels of oil across Norio and Satskanesi, and we've got a 2P reserve number of about 1.6, 1.7 million barrels. So the prize is in Norio and Satskanesi, albeit they are located in the foothill of the mountains, so the kind of access and the topography that we're dealing with up in Norio and Satskanesi is somewhat more challenging than down in West Vestavia. West Vestavia is in the kind of quiet area of the basin. It's a 2-minute drive off of a major highway, and access is extremely easy. So going forward, I think a lot of the resources and time are going to be spent on West Vestavia, albeit we'll probably deploy the A50 workover rig into Norio and Satskanesi and do some simple recompletion work. So there's one of the rigs that we've just secured for a further 12 months, and that's our ZJ40 rig. We use that to re-enter 16AZ, quite comfortably get us down to around 3,500 metres. That rig has drilled many Middle Eocene, Lower Eocene wells in country, and that's what we'll be using going forward. And there's another good picture and a bit of a nice image on the backdrop of Georgia. So in summary, we're a young and ambitious company with significant re-rating potential. We're fully funded to execute a back-to-back drilling program over the next 12 months. We'll be drilling at least 2 wells by the end of this year, spudding our next well in a not-so-distant future. Our absolute focus is on ramping up production, proving up what we believe to be a significant gas resource, and looking at additional acquisitions throughout Georgia. Some stats on Georgia, which I'll leave for now, but thank you for your time.
So that's Paul Haywood, who clearly takes lots of pictures of oil rigs when he goes on his holidays. Questions for Paul? While people are thinking about those, let me ask you straight away. I mean, obviously, proximity to Russia, political risk, you haven't said a lot about that. Yeah. What are the risks of simply being in this region?
That's a question we get asked very often, I must say. Look, I think the industry is governed by production sharing contracts that are governed by English law. You know, I was kind of moving in and out of Georgia back in 2008 when there was a split with Russia, and often that's the point that's raised when we raised Georgia. And you know, during that time, the industry wasn't affected. Needless to say, you know, there's a bit of a juggling act with Georgia between the east and the west, and most recently there's been a bit of poking going on with Russia, which those that follow BBC News may have followed. But in general, the industry is governed by box standard practice and terms of which are governed by English law. So it's a very comfortable operating environment, and I think the previous slide 4 or 5 or so kind of shows what you can get done in country in very simple time. Just to put things into perspective, when we were going for our permits for well 16 AZ, and we submitted our work programme on a Monday, and we had our permits back on the Friday. So in terms of ease of operating, the above surface environment is fantastic, and the Agency of Oil and Gas, which is the kind of the equivalent of the OGA really here in the UK, is extremely supportive and are purely focused on keeping the industry moving. So we've had a very good experience today.
Okay, thank you. Question over here.
Thank you. There's clearly a bit of running room in West Rustavi, and the other two fields sort of have some options there as well. Once you're sort of done with the work programs on all 3 fields, where's next? And would you then move, and would you stay in Georgia specifically, or would you look to another sort of Eastern European country? I suppose the question is, what's the sort of grand running room for Block?
Yeah, what's next? I mean, there's a... the success that we've had today has been interesting in that. Sorry, jumping around a little bit. One of the reasons that we felt it was important to somewhat expedite our initial work program was consequent to the success we had in 16 AZ. We felt that if we continued having that success and continued to kind of prove up the play, surrounding asset values would of course start to increase. So, and what's next for the company? Post the plan outlined today, we're constantly looking at new ventures and new opportunities, both in country and in the surrounding region. Azerbaijan is somewhere that we have looked at, purely because same basin, same play, at least onshore, is a place that is somewhat open to us. But actually, we see, we've worked extremely hard in creating a bit of a unique position for ourselves in country, whereby we're now a proven operator, we've got proven success, and we've got all the backing we need from the authorities. So there's a lot of run room for us in Georgia, and I'd most definitely kind of urge people to keep an eye on what we're doing over the short term, and that will start to take a bit more shape. So dancing around your question a little bit, but there's a lot bubbling away at the moment. So yeah.
Okay, and if I could take you right back to West Rustavi, and if you could give us a sense of how much it's going to cost, what kind of time frame you think for all the projects and the work you're going to do there, and when does that work actually begin? Sure.
Well, we're getting these wells down. 16 AZ had a final cost of about $1.5 million, actually. Going forward, we're going to throw a bit more technology at these wells. We're going to go a little bit heavier with our wireline technology. And we're expecting each sidetrack to cost us anywhere between $2 to $2.5 million, thereabouts. In terms of timeline, how long does it take to get these things down? We was in and out of West Rustavi within 60 days, so the forecast is 60 days yet again, but we'd expect to shave some time off of that. So these are cheap wells, we get them down quickly, and we're in a position to monetize any production almost immediately. We've got production storage, which has been made available to us, which has an approved sales point, which we can sell from almost immediately. And we're in the process of building a central processing plant that'll allow us to feed all future wells back to a central point and then sell from that location.
So you sell everything in country, do you?
So currently we sell locally. We can export our own at our own discretion. So there's two routes available to us. If we sell domestically, there's a local refinery that takes all we can offer and more. They pretty much refine and then again sell locally. Or we can export to Batumi to exporters who then sell our crude out into Europe.
Great. One more question over here.
You had a really exceptional result with that well. How do you know that that's now the rule and that wasn't just an exception?
So, yeah, another good question. I mean, it's easy to say, kind of standing here today, off the back of success, but our expectations internally was always 1,000 to 1,500 a day. And how did we get there? If I just, it's always easy to make things slightly visual here, but so this permit here has had over 200 wells drilled into the Middle Eocene. We've got the data on all of those wells. We've studied all the production data. There's another analogue field which is up in the northeast corner here, Ninot field, which is what we based the West Rustavi play off of. And we've got kind of initial production rates in Ninot at least ranged anywhere between 1,000 to 2,000 a day. So we was always targeting anywhere up to around 1,500 a day, but we thought it was best to, at 300 a day we're still extremely commercial, but in this market we thought it was better to be conservative, manage expectations, and if everything goes extremely well, then all the better. So do we think we can do it again? Absolutely, otherwise we wouldn't be there. We're not in Georgia to produce 1,000 a day, that's for sure.
And what are the decline rates? Like, what's your internal assessment on what the decline rate's going to be?
So our P50 decline rate is 1.5% a month. But we think, based on how we're producing this well currently, I mean, it's an extremely strong well that we have in our hands. I mean, it really wants to produce, but we're producing it we're being somewhat delicate with it currently, whilst we're running lots of different tests to understand exactly how we should produce this thing. But we think at 700 to 800 a day, this thing will plateau. We're expecting a year and a half plateau out of it before we start seeing any declines.
I'd actually like to just briefly ask Andrew and Graham, because I can see everybody, including me, sort of studying these pictures of oil fields and nodding wisely at the angle at which the drilling was going and all the rest of it. How obviously these are technical matters which you have to assess as chiefs, along with all the other operational aspects of running a business. But sort of looking at this operation, how you compare and contrast the work you're doing in the countries you're working in compared to what you see here.
Well,
yeah.
If I go first,
Yeah.
of all, obviously this is onshore rather than offshore, but the process that's is described, clearly looking at analogues, drawing parallels and getting insights from that is clearly very, very important. It sounds as if the work that the team are doing is very, very sound, and obviously can't necessarily comment on the subsurface, but it sounds like it's very well kind of thought out strategy.
Sure. So thank you very much indeed.
Thank you.
Thank you.
Cheers. Thank you.
And we move on now to Zac Phillips, who is an independent oil and gas consultant, a highly regarded individual who's covered the oil and gas sector for many years, working for companies such as BP, Chevron, Merrill Lynch and ING Bearings. Latterly, he was Chief Financial Officer to Dubai World's oil and gas business. Some of you may be familiar with DB Petroleum, responsible for risk valuation and risk management, I should say, valuation and the authoring of investment proposals. So he's got a pretty good overview. And I think having heard from three very different companies this evening, it's going to be rather interesting to see his overview of the industry, different investment proposals, and how he sees the whole scene.
Thank you. Almost didn't recognise who he was talking about, to be honest with you there. But I guess one of the things that we do is what do we really look for? It's start with the asset. It's the size, the risk, and the doability. That is to say, is the juice worth the squeeze? Is it big enough to accompany the risk, and can it be done given the skill set that we've got available to us? The next real question comes down to the management, its track record, its skill set, and its ability to execute the plan that it's got. These are the guys that are going to be squeezing the asset. They're going to be applying the pressure to squeeze the juice out of the, and in the press, as it were. And the next thing, which we can't ignore, is jurisdiction. The risks, the fairness, and the tax structure. The tax structure really comes down to the way in which you access the benefits of what you've done. The fairness, and that might seem like quite a trite word to put in there, but if you disagree with the tax inspector, are you going to be getting a fair hearing, or are you going to be told this is the way it is and suck it up? And of course, the risks really relate to what extent do your host government change the rules on you? Because let's not forget that a lot of these investments are made over an extended period of time. Paul's been in Georgia since 2008, and there's been a significant change in that period. So really, where we see all of these things coming together creates value. And there is no doubt the asset, is the juice worth the squeeze? The management, have we got the ability to be able to apply the pressure to squeeze the juice? And jurisdiction, how much of that juice can we keep at the end of it? So it's rather interesting to hear everybody talking about valuations. Now, what we really have to get down to is the gap between value and worth. Now, if we look here, what we see is we've got EV and the sum of parts at the bottom. And if you just in a rough parallel here, we've got assets trading significantly below where the EVs of the particular asset bases are. That means that there is always a disconnect between value and worth. What is value? Maybe we should explore that. Value is quasi-scientific. It's often done at desktop and is divorced to some extent from the underlying market and the psychology. That regard which something is held to deserve the importance of usefulness of something. Okay, let's keep that in mind. Worth. The level at which someone or something deserves to be valued or rated. Now, we can boil that down on the entire right-hand side to a single statement. What someone is actually going to pay for it. Okay? This is the key difference between value and worth. What causes that? Well, sometimes it's a concern with management, a technical skill set, a financial sophistry, or an ability to deliver. So here we have an asset. Can we get that management to deliver what it is they say they're going to deliver? Price deck. Now this is a rather interesting one. Valuations are always based on a number of input parameters. Price deck is just one of those. So whether you're using the forward curve for your oil price or your gas price, or whether you're using some standard or benchmark being provided by your valuer. Often it lacks appreciation of risk to price. If you were investing in a project in 2012, it would be a significantly different outlook on the future price deck than if you were investing in, say, 2015, when we reached the absolute bottom of the oil price market. And of course, timing. Everybody expects there to be a fluctuation in the price, but it's just about when. For companies, it also comes down to the portfolio risk. What's the asset mix? Is it oil? Is it gas? Geographical, is it in Russia? Is it in North Sea? Is it onshore, offshore? These are some of the questions that a lot of investors look at. And because we're all making a subjective interpretation of what impact these things have on the value of a particular asset, we assign a different worth to it. And of course, the good old hydrocarbon. Is it gas or is it oil? These are some of the other things that are significant drivers to providing the discount between value and worth. Okay, And again, the project, the route to valorization and fundability. Now, these are often quite overlooked. The route to valorization is perhaps more keenly felt in the difference between a gas asset and an oil asset. There are some very large gas assets that have next to no worth because they are removed from the markets, and the costs to getting them to a market are significant, which of course then brings us on to our fundability. Now, you and I, as equity investors, what we want to make sure is that if we put our pound in today, that we're not going to be diluted with future fundraisings. So when you've got a project, one of the other big differences that drive equity psychology is to what extent will a particular project be able to access the alternative capital markets, whether it's prepay structures from the traders or even senior secured debt pieces from the large institutional banks and pension funds. So these are some of them. There are others, of course, but these are some of the main causes that drive differences between value and worth. Now, the value gap in reality, what does that look like? Well, if we look here, and what we're looking at here are liquids in North America. As you can see, we've got the reserves down at the bottom, and we've got our EV up on the y-axis. And it's not so much the numbers that I want you to look at here. It's going to be the interrelation between the two that we've taken here. And I've deliberately chosen two diverse groups here: liquids in North America and gas in Russia. So what you can see here is that for any given value of reserves, if you're a liquids in North America, you're going to be valued, or you're going to have a higher worth that's significantly in excess of your compatriots in Russia, who operate in Russia. So this, in reality, is what we're talking about. And in this particular instance, we're talking about the risk, the geopolitical risk, the fairness of the particular tax structures that you're operating in, and of course, the actual tax structure itself. And of course, our old friend doability, liquids versus gas is a completely different concept. For gas, you need to increase the complexity and the control over a particular process twofold over liquids. So what does that all relate to? What does that all come to? Well, what we have found is that listed E&P companies trade at around about 35 to 50% of their implied valuations. That means that you can expect, depending on where you are, a 70% discount or a 65% discount to your value as being your market worth. Now that can be significant in some instances, and it really does bear keeping it in mind when we start talking about the interoperability between asset value and market worth as reflected in the public markets. What I thought I'd do is I'd take you through perhaps how some of these things have a real impact, and how going through some of those processes can see values change over time. Okay, so here we have our case study number one. We've got, again, EV up here. This is in millions of dollars. 1 million, 10 million, 100 million, a billion, 10 billion. And reserves, 10 million, 100 million barrels, and a billion barrels right at the far side. So this particular company came to market looking to fund an exploration well. Pre-drill estimates put it at around about 800 to 900 million barrels of oil equivalent. They had identified it with a significant prospective resource, raised the money on IPO, and drilled the first well. As we can see, what happened is there was a drilling success. The volumes shrunk, but the value went up significantly. Could we say it should have gone up more? Quite possibly. But here we come to the other driver in equity markets: fear and greed. Greed is driven by the fear of missing out, and the fear is driven by the greed of wanting to maximize and get as much bang for your buck. So what we've had is we had a drilling success. There was an appraisal program. As part of that appraisal program, they were able to convert a lot of the prospective resources into contingent resources, which were subsequently booked. A next round of appraisal actually saw the next drilling program further reduce the volumes, but such was the de-risking in this particular case that the value, as we could see, went up substantially. And this pre-drill or this pre-development volumes are the ones that are being used to sanction the development. So if we look here, the risk, the only difference between here and here is that the risk has really been eliminated. Substantial value has been created. Case study number 2. We've got a company with a diverse set of assets. There's been a change in strategic direction to sharpen the focus, and the cash that's existing in the company is going to fund that change of strategic direction. So what we have here, the original portfolio, considered relatively unattractive, not an inconsiderable amount of oil here, that's for sure. So announce the change in strategy, the new portfolio. People are excited, they want to be part of it. So you see a modest increase in reserves, but again, we see a corresponding increase in value. The extended appraisal program shows yet more interest in this particular asset base, and the volumes increase, but the value increases almost exponentially in comparison to the increase in volumes. However, what we've had in this particular instance, there has been incremental improvements in the volumes, but there has been such delay to the disclosure of a cogent development strategy that people have got concerns that the project is doable. So this, in real terms, is what we're seeing here. Is it going to happen? You've been telling us it's going to happen, but is it going to happen? Okay. Case study number 3. A company with a huge set of diverse and producing assets, very strong cash flow, significant portfolio at all phases of the exploration cycle. And in this particular instance, we have a healthy cash flow supporting an active appraisal program, and from IPO, we see it moving both ways, both increasing in value and in reserves. What happens is that we have the development projects further driving the reserves, and that further increases the value of the company. The oil price sees everything that this company is doing basically coming up gold. Even what was marginal before is now becoming profitable. But wait. The project growth and reserves bookings are actually improving. But here we have a management that's actually beset by rumours of corruption. Now, corruption at the management, at the C level, is corrosive to the interpretation of value. Because if you can't trust your management team to deliver on your behalf, why would you hold the asset? What we saw in this particular case is a continued disintegration of confidence and an incompetent risk mitigation strategy. Now, in this particular instance, it was a failure to take account of the impact that lower oil prices will have on your ability to pay back your debt. Now, debt, you have to remember, is like a Siberian tiger. If you keep that beast fed, it'll be nice, it'll pose for pictures. But if you starve it, it'll see you as its next meal. And so that proved to be. So what we had in this particular instance was a crisis as the management was ejected from the company. The shares were suspended, and at this point, the equity holders don't know what's going to happen. Will the debt holders, will they perfect their security package and take away the assets? Or do they see more value to be had from exercising their right as bondholders to take equity in the company at a price pretty much at their choosing, diluting all of the existing equity holders, but you still have a shareholding. Now, this is what happened with Gulf Keystone. The bondholders, they took the equity holders, the existing equity holders, I should say, would dilute it, but you still had paper that you could trade, with a hope that in time you could recover some of the value that unfortunately you've lost. These things can be quite powerful because if you can get the conversion between the debt and the equity right, the existing equity holders actually sometimes see an improvement because the disappearance of the drag of the debt from the balance sheet is a positive effect, and it offsets the dilution effect of the additional equity. So back to our case study number 3, the shares are suspended. What does the bondholder choose to do in this instance? It chooses to take the assets. It pushes the company into insolvency. Investors lose their entire holding. It goes completely. Now, these are some of the issues that we all need to bear in mind when we're investing in equities. We may think they're just little parts on a screen, but they have real value. They have real impact. And for all of the guys here today, everybody, it is the lifeblood of the business. So, conclusion. Value and worth are not the same thing. The assets must provide suitable upside or be worth investing in. A clear plan on how to realise that value will give investors confidence that the management teams know where they're going, they know the risks, and more importantly, that you've got confidence as an investor, as an owner in the company. I hasten to add, you own the company, it's your company, that they're going to weather that storm with you, and they are going to be able to pilot your company to smoother water. And that is where the management team are essential at the smaller end of the market. Because in essence, it's going to be the management team that's going to deliver on your plans, on your asset values. And with that, that's me done.
Thank you, Zac. So, any thoughts with regards to your own portfolios, your own experience as an investor, particularly in this sector? Okay, well, maybe... Is that a question or is that just a comment? Just a statement, okay.
Well, of course, I mean, what we all have to do and what our responsibility is as investors is to make sure that we understand the risks that we're actually getting into. It's the management's responsibility to articulate those risks. They're not going to make the decisions for you. They're going to be focusing on their assets and they are going to be wanting to make sure that they deliver on what they say they're going to deliver. There are always going to be risks. That's why equity is there. So it is, you're absolutely right. Some of these things are quite sobering, but we must always understand the risks.
Stay there, Jack, just for a minute, but we've got two managers here. I mean, what are your thoughts when you hear this from the point of view of the investor and the assessment process the investor makes? What thought do you give to your investors and the sort of process of how you deliver for them?
Well, you're probably asking the wrong person because as a member of the management team, I'm always going to say that our company's undervalued. I do genuinely believe that, but that's one for another. Clearly, there is a mismatch, I think, in a lot of cases, and as you say, the risks have to be sort of weighed up with the potential returns. I'm certainly interested by the statistic that you put up around companies sort of trading at sort of between 35 and 50% of the implied NPV. Certainly from my experience, I probably see it as even lower than that, simply because we've all got projects that certainly we feel we've had CPR'd or independently assessed as having much larger NPVs. Obviously, it depends where you are in the cycle, but often it feels that it's even more of a discount than that.
Thanks, Paul.
I thought it was a very clear and concise presentation, actually, and I thought it touched on a lot of key points that are often missed at this end of the market. You're absolutely right. I think one of the key ingredients, especially I look for it as a fellow investor also, I mean, outside of Block Energy, of course, is management. Can the team deliver? And I do think that quite often you've got to take a deep dive yourself to get confident on the plan being able to, the management being able to execute the plan. So,
and of course, you are investors yourself, of course, in this process. We've got a question here.
Have you got exposure or an experience in relation to deep water assets in oil and gas? And what's the criteria you tend to look, because it's quite challenging, ultra deep water assets, generally speaking. And I'd just like to get your viewpoints upon that.
Well, I think it really depends on what you're talking about as ultra deep water and
3,000 meters and above.
Well, I mean,
below in that case.
To be blunt, it's just an engineering challenge to overcome. What sometimes a lot of people look at as being hurdles and issues is just applying the same principles and the same bases to a new regime or to a new situation. The reference to ultra deep water, I think, is actually quite a pertinent one, because 10 years ago you probably wouldn't have even thought of drilling in 2,000 meters. That would be beyond the scope. And it's not until people start over-engineering and then thinking, well, we've over-engineered this, how are we going to actually test what it does? And they push that edge and they push that envelope and they push that envelope, and with every iteration you learn more. And in many ways it's like an appraisal program, is that each well gives you more information than you had before, and it will tell you more about what you can do and what you can't do with an appraisal program, with a particular asset. But in an engineering sense, it'll tell you what you can do and what you can't do with the physical construction. Now, the great thing about the oil and gas business is that it does innovate and it does push, and it's the open market and it's the free market that actually drives that. It was really the drive to want to try and offset some of the significant profits that a lot of these US companies were making onshore, that they started investing in R&D programs that made ultra-deep water in things like the Gulf of Mexico, ultra-deep water, possible, because they felt it was a useful tool to write off their tax dollars so that they can actually say, okay, now we're investing in the future, we want some R&D grants, we want some R&D tax credits, and away we go. And now out of that, let's not forget that 100 meters in the North Sea was considered really, really troubling in the 70s. Nowadays, such is the availability of technology, of engineering knowledge and know-how and construction, is that you can go to one of maybe 15 vendors that will construct to exactly your specifications, to exactly the grade that you need it to, so that you can go and put your platform in 110 meters of water. You know, and that's in 40, 50 years. I mean, that's truly amazing.
Okay, another question over here. Perhaps just take
Hi,
one more
one
after.
question. More often than not, you see the oil field are in the sea or the offshore, yeah? So what's your general view on the onshore oil exploration, in particular the UK onshore oil industry? That's question number one. And number two is, which field or region do you think is more promising in your personal opinion? Thank you.
Well, I think the difference between onshore and offshore is really made stark by the kind of issues that those that are chasing the shale series in the East Midlands Basin are facing today. You know, we've been fracking for 40 years. It's now suddenly become very unpopular, but that understanding, or rather that desire to want to stop fracking, really stops at the coastline, because offshore nobody really cares the fact that we've been fracking for about the last 20, 30 years, and in fact to maximise recoverability from some of the fields that are legacy, if you like, are at the tail end of production. We've been happily fracking those for about the last 10 years. So, you know, it's about, to be honest with you, onshore UK is, there are a lot of headwinds. Oil onshore UK is even more headwinds. Gas, I think that there's going to be, there's more of a follow through, but anything that uses the U, as in unconventional, is going to find it very difficult in the United Kingdom. As for what you're asking in terms of the next hotspot, I think that's. I mean, it's always really difficult to predict that. But the last hotspot was offshore Guyana. Now, offshore Guyana has been on everybody's radar screen since about 2002, 2003. We looked at a number of projects in offshore Guyana for fractions of the type of investment that was required today. But what really brought that home to me was the fact that I was at the Africa Oil Week, and although you're supposed to be there and talking about oil and gas in Africa, nearly everybody was talking about the recent results and the pending drill program in Guyana. So there, you know, even I noticed what was hot and what was not. The next one, I think, in my opinion, what we've seen in places like the United States and some of the traditional basins is a consolidation of players and the pullback of liquidity, which has meant that the threshold for investing has risen. If we look at the United States, that threshold is now at around about the $1 billion mark. A market cap of $1 billion is what you need to be considered small cap in the United States. That means that there is a tremendous amount of money that is going to be required to be invested in onshore United States, even in legacy plays, that's relatively low risk, but is going to want to find a home. And I think the next best place for some of these guys to go is to come to London. And it's going to be interesting to see, but you know, I think that there is, I think the US onshore, Permian Basin accepted, but the US onshore is going to start to show certain promise certainly in the oil and gas segment.
Okay.
Thank you very much for your time.
Well, thank you very much indeed, everybody.